Hey everybody, and welcome to the PlantStock channel. If we haven't met yet, my name is Jesse. Tonight we're going to focus on the Very Good Food Company, aka the Very Good Butchers. And we're going to talk about the news that came out yesterday regarding that they've gotten a 70 million credit in an effort to try to help with their expansion. So we're going to talk about what that means for their future goals. And I'm also going to give you some thoughts and opinions as we move along the article, right? But before we get to it, as always, guys, I would truly appreciate an early thumbs up since it does really help the channel expand to more people. And also, if you want to keep getting more information regarding Very and other plant-based stocks or having some investment philosophies on the way, make sure to subscribe to the channel and don't forget that bell button, right? Thank you, guys. Truly appreciate you. So if we move on to the news from yesterday, the Very Good Food Company announces signing of committed 70 million credit facility non-binding term sheet with prominent institutional investment firm. Wow, that's a mouthful, right? So what does that actually mean? If we just read from the article here to begin with, quote, upon closing the proposed financing, Very will have access to a senior secured 20 million revolving line of credit and a 50 million asset-backed term loan. So this is in Canadian dollars again. All amounts drawn under the credit facility will pay interest at a rate of 9.95% per annum and will be repaid in full upon maturity. The credit facility proposed will have a term of 24 months with an option to renew upon mutual consent for another 12 months and will primarily secured by company's current and planned production equipment. So basically, this means, if I understand it correctly, that this loan of almost, of $70 million is supposed to be paid back within 24 months or 2 years, or could be renewed for up to 12 more months, which would be 3 years, right? And that does sound kind of quick, and it's quite a large of sum considering this is a company that might have a revenue of this year between 10 to 15 million dollars, right? And then thinking that they're supposed to pay back 70 million with interest within 2 to 3 years, that seems quite steep. But I don't think that's something we have to worry about that much, considering the facilities they're building up now, their revenues in the years to come will be, I think, at least tenfold to begin with. So I'm not worried at all. But if we go through it step by step again, so financing highlights. So it says here, proposed 70 million credit facility will consist of 20 million revolving line credit and a 50 million senior secured asset-backed term loan. Interest payments only on drawdowns and repayment upon maturity. Right. So I think this is quite obvious. The 20 million is a credit, right, that they could take. But what does the 50 million senior secured asset mean? And basically, that is that they're using their company, the facilities and everything they own as a form of guarantee that if it doesn't work their way, if they're not able to pay back the loan in full, they'll use the whole company as a guarantee, right? I took a look here in Investopedia just to, if there are some people that are wondering about it. And here, what is a senior bank loan? So a senior bank loan is a debt finance obligation issued to a company by a bank or similar financial institution and then repackaged and sold to investors. The repackaged debt obligation consists of multiple loans. Senior bank loans hold legal claim to the borrower's assets above all other debt obligations, right? So because it's considered senior to all other claims against the borrower, so it doesn't matter whatever other things they have to pay back, in the event of bankruptcy, it will be the first loan to be repaid before any other creditors, preferred stockholders, or common stockholders receive payment. So senior bank loans are usually secured via a lien against the assets of the borrower. So the reason why they can get those additional 50 million, in my understanding, is because they can use the whole company as a guarantee, right? So if they would go into bankruptcy, they still have to pay back these people first, this institution. And so what are they using this money for? As it says here, accelerates the commissioning of the first 2 production lines in various facilities in California, which is obviously the Patterson facility, right? estimated to be around 30 million, with the purpose of scaling existing products already in the market with proven demand. Obviously, this is something we expected, right? It's not enough to just open up a huge facility that's going to help them make about 100 million pounds of meat alternatives per year, right? They have to fix them up. It's also supposed to be used for significant financial flexibility to support various e-commerce sales growth strategy in the US and in Europe, as well as the company's working capital requirements. And I find this very interesting. This is actually the first time in a long time that I hear them mentioning Europe, and that's something we're going to talk about later in the video. And then they state further, strong financial commitment with competitive market terms, including a proposed single-digit interest rate from an institutional investor representing strong confidence in VRYYF's team, long-term growth strategy, and product portfolio. I think I do understand what they mean. I mean, it's a really good sign that they're allowed to take this kind of loan. That means that this institution kind of believes in them, right? There would be no purpose otherwise to give them a loan of this size. I do feel that in the article, they're kind of bragging about a single-digit interest rate, which to me is kind of funny, right? Because really single, it's 9.95, so it's pretty darn close to being a two-digit interest rate. But yep, still, I get what they're saying. And then we come to the low cost of capital, minimal dilutive effect, size and attractive pricing of the credit facility are consistent with VRYYF's commitment to generating shareholder value. So this is actually good, right? They want to be careful with diluting the stocks for us, you know, which would mean that if they start diluting it even more than they've done already, that would mean that what we have is actually less worth. But I'm not worried about that because I expect they will be doing that more and more in the future, because that's what every great growth company does. So nothing to be worried about in my eyes. And the end part here is the long-term business partnership with a leading institutional lender interested in continuing to scale financing as VRYYF executes on its brand strategy throughout potential M&A opportunities and organic growth. And if you don't know what M&A is, it's merger and acquisition opportunities, right? Which gives us a further understanding that, as we know, they just acquired the Culture Nut, but they're apparently maybe planning to buy more of these smaller companies, preferably maybe other plant-based companies, right? So also something we're going to talk more about in the end. So stay tuned. And this is what the CEO, Mitchell Scott, had to say about this. Quote, "This proposed financing demonstrates VRYYF's ability to access capital markets with favorable terms based on strong fundamentals. We believe that this financing signals that our business plan and sector have major growth potential, which VRYYF is poised to execute upon to meet the existing and future demand for our products." So if we go into a little more details regarding the loan in itself, right? It says that, as we know, this is still not a done deal, right? They're negotiating up until April 15 here, right? And I do know that probably a lot of you have some questions. I've already seen it in different forums, that if they're already getting an interest rate of almost 10%, right, this institution, then why do they need to have shares as well, right? Because it says here, consideration for the credit facility is anticipated to include 225,000 common share purchase warrants of VRYYF at the 25% premium on the closing price as of the date of the first draw under the definitive agreement. So what does this actually mean? Well, this means that this institution, whatever institution they're actually getting this money from, and at first I thought it was kind of weird, you know, that why are they not mentioning which institution, which lender, which company this is? But I think because it's not a done deal, right? You don't disclose that kind of information normally then, I guess. But I think the reason why they're actually offering them these 225,000 common shares is because to get a more favorable deal, right? So some of us might feel that 9.95 as an interest rate is pretty high, but I would imagine that it would be possible that it could actually have been higher. But giving them these amount of shares and at the premium of 25%, probably was part of the reason why they could get it to this so-called favorable interest rate. So what does this mean for this institution? What can they do with these common shares? Well, my understanding is, and guys, correct me if I'm wrong, but let's say that is actually everything is done, it's a done deal, and it is occurs on April 15, which is about a little over a month from now. And for some reason, to make it simplify it, let's say that the very stock is at about $10 per share, right? Well, that means that they will get a 25% premium, which means that 25% from would be $7.5 up to $10, which would mean that they would make between about $2.5 bonus directly if they were to sell it at that date then, right? So that would mean $2.5 times $225,000 common share purchase if they would be selling it at that point, which I would think would be insane, right? But that would be their choice. And again, if we keep talking about the rate here, the 9.95%, almost 10% interest rate within 2 years, right, or up to 3 years, depending. I mean, it could be considered a high rate. But again, if you remember in the early days for VRYYF, they were actually getting other loans that were way higher, maybe not at this sum, but they weren't expanding like this at that moment either. But I remember seeing numbers around 40 to 50% in interest rate. And then I took a look at their financials now from the summer. I saw several different loans around 15 to 20%. So I would say that this actually looks way better what I've gotten so far. And I think it is because they are expanding. They're becoming a brand, a company that is more noticeable, right? And my understanding also is that it has to do with market valuation, right? What your market cap is. So if this was a company like, say, Beyond Meat, which is 20 times more worth on the market at the moment, Beyond Meat would obviously get more favorable terms, right? Because they're a much larger company. So one of the reasons why they are getting these so-called higher rate is that, they're still aren't that big of a company, right? So this means that I believe that in the future, when their valuation is much larger, which I do expect them to be in a couple of years from now, they're going to get more favorable loans, right? And I understand that some of you might feel like, why they shouldn't be borrowing money at these kind of sums, but you have to do that. We've talked about this, guys. This is a growth company. It's a disruptive company, right? They need to expand. They need to grow quickly. And they have his vision, the CEO's vision is extreme, right? He wants to expand aggressively into not only the rest of Canada, but in the US too. And you need capital for that, right? To be able to make money, you need to spend money, right? And as a business, you don't always have that kind of amount of capital in the beginning, which VRYYF definitely doesn't have, right? Like we talked about, they're getting a revenue right now that's around $10 to $15 million, maybe. We'll find out soon. And then imagine if they need these kind of sums, that's around 30 to 50 to $70 million. You need to do something, right? So, and most companies that have become extremely successful have chosen a similar path, Tesla being one of them. I mean, my God, just a couple of years ago, they were almost going bankrupt, but they had to keep getting those loans, right, to reinvest in the company and to try to keep expanding and building up the production lines and the facilities to get them going. So it's nothing strange at all. And it's the same thing with Jeff Bezos and Amazon. They have the same history, right? Leveraging the loans as a way of actually expanding your company quickly. So me personally, the way I look at growth companies and disruptive companies, this is natural, nothing to be worried about. Actually, it's a good sign that they believe in themselves and that there is a huge institution out there that are ready and prepared to give them this loan. Sorry, guys, you might notice now that I have a different shirt and I have a light on my face now. And that's because this part that you're seeing now is actually filmed today. The part you just saw now was filmed yesterday. When I came home from work yesterday, I realized that I forgot my charger to my MacBook. And I realized that if I drove back to work, it would take me about 1.5 hours back and forth, so I realized that I just had to give it a try. I had like 22% left. and it wasn't enough, unfortunately. So that's why you see a bit of a change in scenery here, right? Or close and light anyways. Okay, but let's go back to the end part of this video, my final thoughts on it. So if we quickly just go back to what we talked about in the beginning, that they're getting a loan, basically, that's around 70 million Canadian dollars, and that they have about 2 years to pay it back, or depending up to actually 3 years. And that does seem like it's a kind of steep sum, right, to pay in that quick amount of time. But I'm sure the interest was probably based on that too, right? And considering, like we said, it's only about 10 to 15 million in revenue now this year, probably, but we can't compare it. We have to remember that they used to have a facility that could only handle around 500,000 pounds of product, right? And now they established a new one so they could actually they improved upon the one they had, my understanding is anyways, so they could now actually deliver about 1.3 million, which is still very little. But that's going to change as this years move on, right? So the Rupert facility with 37 million again, and 100 million pounds in the Patterson facility. Obviously, these are just max production, right? These are perfect conditions. They're not going to be there in a year from now. Not sure in 2-3 years from now, but I think it's going to go quite quickly anyways. So if you're thinking about the amount of revenue they'll have within 1 to 2 years, I feel pretty certain they'll at least like tenfold it, right? So that's going to be a huge change if they get like 10 million in revenue now, or 15 million, we'll see. And a year from now, they'll get about 100 or more than that. And I actually do see that as a possibility, again, considering that they had huge demands all during this last year, right? They couldn't fill the demands. First, it was like 5 to 6 weeks, then was down to 3 to 5 weeks. Now it's around 1 to 2 weeks still at this moment, right? So people are really loving their products. They want their products, but they haven't been able to facilitate them considering the production restraints. Now they're not going to have that trouble, right? So I'm not worried about them being able to come up to those huge revenues so they'll be able to finish this payment back. So I'm not worried at all. But again, one of the more interesting things I found about this article was the discussion about the Europe part, right? That they want some flexibility with this money, so to use in their e-commerce sales growth strategy in the US and Europe, right? And I remember doing my first video regarding the Very Good Food Company, like it's about 4 months ago now, I think. It was one of my first videos. And it actually stated that in the end of that presentation, in their investor presentation, that they had some patents even in Europe, not only in North America, but in Europe. And that got me going like, could they be having plans about expanding to Europe? I remember, I think some interview that was really old, that they had some discussions about it, but we haven't really had any news about that as of late, or for several months anyways. So I do find this interesting. And I'm wondering, could this really only be e-commerce sales that they're talking about? Because that sounds kind of weird also, like they're going to send from North America to Europe. I mean, those kind of prices would be immense, right? So I'm wondering, when they're talking also about what we talked about here, about M&A, right? Mergers and acquisitions, it would make sense that they might get a acquisition of a smaller facility in Europe. And I'm actually thinking about Germany here. And why am I thinking about Germany? Well, that is because Berlin, which is the capital of Germany, is considered here in Europe anyways, the vegan capital of Europe, right? They have a lot of vegan restaurants. They even have a Veganstraße, which basically means the vegan street, a whole street that is dedicated to vegan businesses. And I'm not sure if it means that mostly vegan people live there, but they're really dedicated in Germany, overall in Germany, but especially in Berlin, to vegan food and plant-based food. It's a really huge movement there. And a lot of the products we have in Sweden are German products, and they're different kinds of different kind of sausages, meat alternatives, cheeses that are coming from Germany. So I would expect that this could be really popular in Germany to begin with, and throughout the rest of Europe. And if we haven't talked about that before, I think the veganism is growing stronger and stronger in Europe as the years goes by. And one of the reasons is for health, of course, and definitely for animal rights. We talk about it a lot over here, but also sustainability is really huge here. I think to some extent, in politics wise anyways, it's probably larger in Europe than it is in the US, especially I guess during the last 4 years. Hopefully that's going to change now, considering, if I believe it, if I understood it correctly, Biden has joined the Paris Agreement again, which is good news for all of us. So if they actually acquired a facility here, be it small or bigger, I'm not sure, but that would be a lot of potential there to actually then get, not having to import their products from North America to Europe, but actually creating them here, considering the huge traditions we have now of more and more plant-based meat alternatives. So I think that could be really interesting. And let's not forget, they're even listed. I mean, the Very Good Food Company as a stock, right, as a company, is listed here in Europe, specifically in Germany. So that would make even more sense. So I do see a lot of potential here. And imagine the revenue sources they could get from Europe also, that not only from Canada, not only from North America, which is huge, but I think it's an equally huge market in Europe, considering that we're more people here too. And a lot of people are interested from different cultures and countries here. So I think it's really exciting. So if we're looking at population-wise, right, in Canada, I think you're reaching about 38 million people, right? In the US, it's around 330 million, so a huge market there for various products, right? But in Europe, we're about to reach 800 million people, right? So it's basically twice, if not more, than Canada and the US together. And again, people are super interested in vegan food here. So I think that it would be excellent, because they're also talking a lot about the health aspect of the food, right? That the plant-based meat alternatives aren't very healthy for you. They might be a better for you product than the actual red meat, the red sausage, but still not that good for you. But when we look at the product list or the ingredients list in various items, we've seen that it's not a totally whole foods product. Let's be real there. It's still processed, but it is much more of a whole foods approach than a lot of the alternatives out there. And I think that will do them really well here in Europe. And that's something I would look forward to. So I don't know, guys. What do you think, guys? Will we soon see their products here in Europe? I'm hoping we will. All right, guys, this was a bit of a weird video today because it is both from yesterday and today to put together, but I hope you could bear with me. I wish I could have actually given you this video already 2 days ago, but this is the situation, and I hope you can bear with me. So, guys, thank you for today. But hopefully you still found some value in today's video. And if you did, please smash that like button as always, as it will help me out immensely. And also, if you want to keep getting more information regarding the Very Good Food Company, aka the Very Good Butchers, or other PlantStock companies, make sure to subscribe and don't forget that bell button, right? Thank you, guys. And as always, should you forget, I am not a financial advisor. These are just my own thoughts, my opinions. Always do your own due diligence and invest safe. Thank you and peace out.